18 of 19 series are aligned with STAGFLATION mild this morning. That is near complete systematic agreement across the 19 series the framework monitors. The current macro regime is STAGFLATION mild, with a confirmation score of 18 out of 19. In regime terms, STAGFLATION mild means the math is observing growth momentum decelerating at -0.6143, while inflation momentum is accelerating at +0.0081. The macro regime label is a shorthand for that joint configuration of growth and inflation composites. Coherence score remains elevated, indicating that the underlying inputs inside each composite are telling a broadly similar story. With a confirmation score of 18 out of 19, and a historical persistence rate near 52% over roughly 3-month windows, this is a regime with a track record of sticking around in about half of comparable historical cases. Compared to last week, when confirmation was lower, the step up to 18 aligned series reflects a tightening, not a loosening, of the stagflationary configuration in the math. Historically, environments like this have coincided with choppier equity trends, firmer commodity pricing, and a tendency for real rates and valuation multiples to compress rather than expand, as a description of how prices moved in past datasets. On the rates side, the 10-year Treasury yield is sitting below the 4.45% trigger level. The engine is watching, but has firmed alongside a move index around 81.53. The yield curve slope, T10Y2Y, is green, defined here as a positive 3-month rate of change, while the curve remains relatively flat versus its long-run history. In 7 of 12 comparable periods, this coincided with higher realized equity volatility and a drift higher in inflation readings within 6 months. Those are historical co-movements, not statements about future market behavior. In labor data, non-farm payrolls and unemployment collectively map to a red labor momentum reading, with PAYMs in particular showing a negative 3-month rate of change versus its 1-year lookback. The latest reports, including plus 115K to plus 178K payroll gains and a 4.3% unemployment rate, point to cooling rather than collapsing labor demand. In 8 of 13 comparable periods with red labor momentum emerging from a previously neutral configuration, subsequent GDP prints were weaker and credit spreads wider within 12 months. These are frequencies, not forecasts. Credit conditions, as proxied by corporate spread composites, are sitting in a yellow band. Spreads are off their tightest levels, but the 3-month rate of change is modest and below the engine's green threshold. Yellow here means the rate of change is positive, but less than 1 standard deviation above its trailing median. In 6 of 11 comparable instances, this coincided with higher dispersion across equity returns and an uptick in downgrade activity within 9 months. Within equities, sector rotation highlights green momentum in technology and red in energy. For technology, green is defined as price structure above a rising 200-day measure, with a positive 6-month rate of change that exceeds its median. In 10 of 16 comparable periods, this pattern aligned with stronger relative performance versus broad indices over the following year. For energy, red momentum, price below a flat or falling 200-day measure alongside a negative 6-month rate of change, coincided in 9 of 15 periods with more volatile forward return paths and higher drawdown frequency. These are conditional historical relationships, not prescriptions. For the conditional map, the engine is observing 2 key triggers. If the 10-year yield crosses 4.45% and holds that level for 5 consecutive sessions, inflation composites showed further acceleration in 9 of 11 comparable instances. In the regime context, that has historically lined up with transitions from milder stagflation signatures towards stronger acceleration in price measures. If the fear and greed index drops below 15 and holds for 5 sessions, the confirmation score deteriorated in 7 of 9 instances, often corresponding to regime shifts or internal disagreement among the 19 series. The map is live. These conditions are being monitored daily across all 19 series. Atlas is the automated rules-based engine inside Given Analytics. Atlas is an automated rules-based engine that does 2 things in parallel. It publishes a view of the broader macro environment, and it runs a fixed 4-layer mathematical framework across 407 liquid symbols every trading day. The environment view and the symbol-level condition log are separate outputs, shown side by side. The regime does not select the symbols. The 4 layers do. Atlas monitors symbols independently of any regime label. Members study the outputs and decide what, if anything, to do with them. First, Atlas publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, Atlas runs its 4 layers: price structure, rate of change, risk regime, and market participation, across those 407 symbols each morning. When all 4 layers agree on a symbol, Atlas records it as a potential long or potential short condition under the framework. These are time-stamped model readings, logged for members to examine as historical records of how the math has treated each symbol across environments. Atlas runs the framework. Members study the outputs and environment side by side. This is May, potential educational context rather than instruction. The morning brief is the public surface. The live Atlas dashboard shows the full 19 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.